So in this video, we are going to understand the basics of intraday trading, and also we'll understand what makes intraday trading so special. Why are so many people trying to do intraday trading? Hi everyone, my name is Nikhil and welcome to the fourth lecture of the stock market investing course. This course has only one simple objective: to actually help you understand how to trade in the stock market. So in this entire course, we will be going through how to do intraday trading, how to do swing trading, how to do long-term investment. We'll actually understand how to look at charts, how to form different patterns, how to pick stocks for investing. So if you're someone who's looking forward to the entire stock market investing course, then make sure you do like this video, make sure you do subscribe as well. So without any further ado, let's get on with the video. Now we have understood from the previous lectures a basic overview of the different ways you can trade in the stock market. We have long-term investing, we have swing trading, and we have intraday trading. So in this lecture, we'll only cover intraday trading. Now, what is intraday trading? Now, intraday trading is very simple. It's day trading. So when you're buying a stock in a particular day, in the morning time, let's say when the market opens at 9:15 in the morning, you're buying a stock. And before the market closes the same day at 3:30 p.m., you're supposed to sell the stock. So when you're buying and selling the stock within the same day, it's called intraday trading or day trading. Now, I'm sure you would have come across multiple different videos on YouTube or any other website where people show that they have got a lot of money by doing intraday trading. Now, definitely intraday trading is quite profitable, but if you do not know how to do it properly, you will make a big amount of loss as well. Now, why do people actually love doing intraday or day trading? Well, there are three simple reasons for this. The very first reason is that there is no overnight risk. Now, because you're buying the stock and you're selling the stock within the same day itself, over here, you're eliminating the risk of holding the stock overnight. So overnight, anything can happen. Maybe the CEO of the company has resigned, or maybe the factory of a company has caught fire. So these small changes actually affect the price of the stock. So the next working day when the stock market actually opens, you will see a sharp drop in the price of the stock. So when you're not holding the stock overnight, you're actually eliminating these risks. So that is the very first reason. Second reason is that it actually gives you the flexibility to travel. So when you are working as a day trader or as an intraday trader, you actually have the flexibility to travel and actually trade from different locations, because all you need over here is a laptop and internet. So you can actually go to different locations and work as a digital nomad. And the third and the most important reason is because you actually take the profit within the same day itself. So when you are trading as a day trader, you actually take the profit because you're buying and selling the stock within the same day itself. But if you're to look into long-term investment or long-term trading, where you're buying a stock today and maybe you're selling after 3 years, in that case, you're waiting for capital gain to happen. Maybe in the 3 years stock market crashes, and then it might even take you another 2 years just to recover that amount. So in case of a long-term investment, there's a long-term capital gain or a time period. But in case of day trading, you are actually taking the profit within the same day itself. And these are the three main reasons why people actually love to do intraday trading. So there are two reasons that actually make intraday trading and day trading quite special. The very first one is leverage, and the second one is shorting of the stock. Now, shorting of the stock is something which we will cover in the next video. In this particular video, we will understand what is leverage. Now, what is leverage? Now, in order to actually understand what leverage is, let's actually look at this particular example. Now, let's say that you want to actually buy a house. The house is actually worth $100,000. Now, for buying this house, what do? You go to a bank, you ask them for money. The bank will say, you know what, you put 20% as the down payment and the remaining is what the bank will give you. So the remaining $80,000 is what the bank will actually give you once you put the down payment. So with just $20,000, you are able to buy a house worth $100,000. So in this particular case, the entire leverage which you're getting is almost 1:5, because you're putting $20,000 and the total amount which is there for investing now is $100,000. Now let's say this particular house goes up in price by 50%. It reaches $150,000. So just by putting $20,000, you're able to make a profit of $50,000. Now, let's say that instead of actually buying a house worth $100,000, you actually use the $20,000 and you put in a studio. With a 50% increase in the capital amount, this amount, let's say, becomes $30,000. So you're making a profit of $10,000 here. So when you actually compare right now over here with just taking leverage, you're able to actually make a profit which is 5 times more than if you are actually invested your entire amount into one single house. So if you invested the entire amount into a studio, you would have only made a $10,000 profit. If you had invested the entire amount into a bigger house by taking leverage or by taking a loan from the bank, then in that case, you would have made a profit which is 5 times more. So leverage in simple terms is a loan which the bank is giving you to actually buy something which is worth much higher. So when you're making a profit, your profit also will be much higher. But having said that, when you're making a loss, your loss will also be much higher. Now giving you a very simple example. Now let's say you have a capital of 2000 rupees. Now with that capital, you want to buy a share of Reliance. Now let's say the stock of Reliance as of today, the price is roughly about 2000 rupees. So that means with your capital, you can only buy one share of Reliance. Now you have two options. Either you buy the one share of Reliance with 2000 rupees which you have, or you can actually ask a broker to give you leverage. Your broker would be like, okay, fine, you have 2000 rupees. The broker would be giving you leverage or a margin to actually trade using 20,000 rupees. That means the broker is actually giving you a margin of 10 times. So now when you're actually trading and let's say you make a profit, your profit also is equal to 10 times more because you're trading with a bigger capital. So because you have taken a loan from the broker, remember your original capital was only 2000, but you're trading with 20,000 right now because you have taken a loan from the broker. So definitely your profit will also be 10 times more. But on the flip side, when you're making a loss, your loss will also be 10 times more. So over here, this is why you should be very careful of using leverage, because people actually end up misusing leverage, and when they actually make a loss, they end up losing their entire capital. Plus on top, they end up owing money to the broker as well. Now you might be wondering, in that case, why does the broker actually give you the leverage? Well, a very simple reason. Like I mentioned in the previous video, in case of intraday trading, you actually make more profit with a bigger capital, because in case of intraday, your actually price fluctuation may be only 2 rupees, 5 rupees, 10 rupees, or maybe 20 rupees. So when you're using a small capital, you're not making a big amount of profit. But when you're using a bigger capital, your profits increases. And when your profits increases, which means your broker's commission also increases. And when your broker's commission increases, he generates more money. And this being the reason the broker actually gives you a leverage. Now, if you're trading in the Indian stock market, something which is very important to know is a new guideline which SEBI has come up with. The guideline actually states that from September 2021, the entire concept of leverage will be removed from the Indian stock market. Now, the reason why SEBI is actually doing this is in order to protect the traders. As per SEBI, nearly 90% of traders end up losing their money, or they end up losing their capital because of using leverage. Now, if you are someone who's planning of trading maybe in the US market or any other stock exchanges around the globe, then the entire concept of leverage remains the same. But from September 2021, you will not be able to use leverage in the Indian stock exchange. So I hope you found this particular video useful. I hope you have understood what leverage is and how to actually use leverage. Now in the next particular video, we will be discussing a little bit more about intraday trading, and we'll also discuss about short selling. So if you found this video useful, do like it, do subscribe, and I'll see you all in the next video.